What most people want to know is, was this past weekend just a one-off? Well, a US recession changes everything. The entire world looks and really is very different and much riskier for it. The consequences ripple throughout the global system, producing substantial follow-on effects. Now today is Turnaround Tuesday, and that's the day when markets retrace following a big weekend crash or a shift that extends into a Monday. Stocks are up, spreads are down, interest rates have backed off their extremes. It doesn't look so bad on Turnaround Tuesday. But systemically repricing risk is a process and one that really just got started. What happens next in the short run, that's anyone's guess. But looking a little bit beyond that, the repricing of risk has to continue. The situation in that respect has drastically changed, or more precisely, the majority of people are now aware the situation was never what they were told to begin with. Even mainstream economists are in panic mode, urging the Fed to emergency rate cut and more. And yes, I mean more. Meanwhile, those at the Fed are doing their best nothing to see here routine. Honestly, what else could we expect from officials at this point? They have to say everything is fine. But keep in mind, these are the same people who said the economy is strong and resilient the entire time. They have no clue here. Also keep in mind, this isn't really about Japan. That was just where the repricing of risk was most condensed and most violent. And that actually makes perfect sense, given that Japanese banks and financials had set themselves up to be massively long the soft landing, therefore massively short the recession. So to get any kind of control over that means world-shattering moves, which is exactly what we just saw. So given the nature of this repricing process, it's not over by any means. If anything, it's just getting started. The key here, as always, is going to be curves and spreads, and in particular, credit spreads. So let's take a closer look at those and their relationship to Japan, and then think about what goes on beyond it. Now, this doesn't mean that we're sinking into some worst case scenario, but what it does mean is that there isn't much or any upside left. And what few options we do have available are mostly about limiting and containing the downside. And by limiting and containing the downside, I sure as hell don't mean rate cuts from the Fed. But that's immediately where mainstream economists have turned. Of course, that's where they turned. That's where everybody is told to turn, because this is all about central banks. Well, it's not about central banks, but even the mainstream economists are now panicking. Paul Krugman on X wrote, "So even though I've been arguing for rate cuts, 50 in September for sure, I wasn't calling for an intermediate cut because that might signal panic. But since we may be seeing a panic anyway, that argument loses its force." So Krugman is saying the Fed needs to get up and hurry. Number one, because the economy is weaker, despite the fact that he said it wasn't weaker. Everything changed last week, at least in the mainstream perception, because the payroll report, the jobs data, the JOLTS numbers, and jobless claims, all of it suggesting what we've been suggesting all along, that the half recession has become a full-blown recession. That doesn't necessarily lead to the worst case, we're going to have another 2008 or anything like that, but it does open a whole range of adverse scenarios that requires serious consideration and, in many cases, serious action. Not the Fed, the markets, because the markets, unfortunately, they're not perfect, they're certainly not efficient, and the riskier the markets, the less efficient they become. They are just now waking up to the fact that, holy crap, the soft landing is not likely to happen. Another prominent economist urging 75 basis points rate cuts from the Fed was Jeremy Siegel. Wharton's Jeremy Siegel on Monday called on the Federal Reserve to make an emergency 75 basis point cut in the federal funds rate after Friday's disappointing jobs report. It really did cement the recession case. Then he said, in addition to the emergency 75 basis point rate cut, there should be another 75 basis point cut indicated for next month at the September meeting. That's what he said on CNBC Squawk Box yesterday. That unemployment figure, quote, blew through the central bank's target unemployment rate of 4.2%, said Siegel, who's the chief economist at WisdomTree. On top of that, inflation has gone down 90% toward the Fed's target of 2%. How much have we moved the federal funds rate? 0, he said, and that makes absolutely no sense whatsoever, because Jay Powell and the Federal Reserve, when they say they're data dependent, they don't mean unemployment. They've been focused entirely on CPIs. Remember confidence over CPIs? While they were focusing backwards on past CPIs, the economy got weaker and weaker all along, and they kept downplaying it and downplaying it, downplaying it to the point that just now it's getting to the point where it's no longer, you can no longer ignore what's happening. It's not inflation risk, and it never was inflation risk. It was always about recession risk. And now that the data is starting to look just like the recession case, everybody's saying we need the Fed to cut rates because they don't know what else to do. As I've shown a number of times, history is conclusive. Rate cuts don't do anything. All they do is signal that the last holdouts on the economy are no longer holding out. Well, the markets aren't waiting for the Fed because there's no reason to wait for the Fed. But since it's turnaround Tuesday, over in Japan, after the absolutely astonishing market crash of the last 3 days, and really, the Nikkei 225 was down 20% in just 3 days. From a high on July 11th, an all-time high on July 11th, to a 20% crash in 3 days. It's like 1987 kind of stuff, which is why everybody's thinking, okay, what's really happening here? We've got a U.S. recession. We've got something happening in Japan, all these liquidations that seem to be focused on Japan. What's the connection? And the connection is Japanese firms, Japanese banks, because Japanese banks are a huge purveyor of credit throughout the global economy. They have all the yen in the world and no desire to use it in Japan. So what they do is they use the yen as collateral to swap into US dollars provided by the Eurodollar system, and then either buy higher yielding US dollar assets, or in many cases they further swap into another currency. Because that's what the Eurodollar is. It is a true reserve currency, which means it's a vehicle to transfer funds or resources, balance sheet capacity in reality, all throughout the entire world. That's what Japanese banks do. Because they have so much yen, they have so much capacity to swap into dollars, they become an important source of redistribution of money and credit throughout the entire global economy. And sadly, they bought into the soft landing narrative. They bought the idea that the U.S. economy was strong and resilient because they're oftentimes just a bunch of bureaucrats running these banks. And so if the chief bureaucrat at the Federal Reserve says the U.S. economy is strong and resilient, then the Japanese banks who had a funding problem, they're going to reach for yield. They're going to buy riskier and riskier junk securities because they need the yield. And Jay Powell says it's just fine. So in one of their aspects of distributing credit throughout the world, they have been targeting U.S. dollar, U.S. junk assets. And that U.S. junk has performed exceptionally well because lots of other people, in addition to Japan, bought into the soft landing narrative. So as soon as the soft landing narrative was challenged, if not completely dispelled by recent data, what happens? Well, the Japanese are hugely exposed. They're more exposed than anyone. But it isn't just about U.S. junk credit or junk credit spreads. The Japanese have to pull back in everything that they're doing because, as I said, a U.S. recession changes so much more. So if you're providing credit throughout the entire global system based on the idea that the centerpiece of that global economic system anyway, is going to be strong and resilient, and suddenly you find out it's not going to be strong and resilient, you're not just pulling out of U.S. junk credit, you're pulling out of credit everywhere. And so what happens when Japanese banks pull out of credit everywhere? They repatriate the funds. They pay back their dollar swaps, and they take their money and go home, which is why the yen has surged. Fundamentally, fundamentals of the yen still urge it to go down. It should be continuing to fall, but this is different. This is a complete financial change, where one that we haven't seen since 2007, at least not to this degree, where Japanese firms who are supplying credit, regardless of Japan's fundamentals, in fact, because of Japan's weak fundamentals, they're supplying credit to the rest of the world, but now the rest of the world looks just as bad as Japan. So now they take all that money and bring it home, at least a lot of it home, repatriate those funds, the yen surges, and that's not a good signal. The importance of Japanese firms and Japanese banks in distributing money and credit throughout the global system cannot be overstated. As such, we need to be paying close attention to what it is that has bothered Japanese banks to begin with, forcing them to pull back in such a violent fashion. And that's having been short the recession by being so exposed to US dollar junk credit. And junk credit has its own systemic implications going into the collateral system, as well as margin calls and everything else get triggered by a sharp reversal. And that's exactly what we saw over the last several days. I'm going to use the Bank of America Merrill Lynch High Yield Master 2 Option Adjusted Spread here, which is an index, to get a sense of where credit spreads are and how they performed recently. And they had gone down to ridiculously low levels because of Japanese firms reaching for yield. And as Japanese firms reached for yield, other investors piled into it because it seemed like sound reasoning. The lower spreads went because Japan was buying them. The more that seemed to confirm the soft landing. And the more the soft landing seemed to be happening because credit spreads were lower, the more people wanted to buy it. It was a bunch of circular reasoning that we see in the stock market. But anyway, it depressed credit spreads enormously over the last really year or so, going back quite a ways. And then just recently, credit spreads reached a low. Some of them turned higher in June. Some of them continued. Some of them got lower in July. The Bank of America High Yield Master 2 was one of those that didn't reach its lowest level until July 23rd. So much sanguinity about the U.S. economy, strong and resilient soft landing and everything. And then Joel's unemployment claims and jobs and unemployment rate just obliterated the idea of a soft landing. So July 23rd, credit spreads, at least according to this index, 302 basis points, jumped to 325. It's a pretty substantial move by July 31st. And then the fun began with last Thursday, 372 by Friday, August 2nd. And today, I actually had to delay recording this video because it took a while for this index to be updated, which is an unusual occurrence, and it's usually a sign of liquidity problems in high yield credit. This is something I ran across all the time back in 2015 when we were same problem, junk bonds and junk credit, leverage loans, all that stuff. The S&P LSTA Leverage Loan Index, I checked that thing every day, and on days where there was lots of turmoil, the following day they would take a while for them to update the credit spreads and the prices, because not all of, while these are the most liquid names supposedly in these categories, when there's problems in liquidity in these marketplaces and these market spaces, these particular market spaces, sometimes not all the names in an index trade on a reliable fashion. So while we don't know for sure why the update for yesterday was delayed, there's a good chance that liquidity problems in the marketplace over the last couple of days may have created difficulties in pricing the index. So I had to wait for that information to post, and what it did, it was 393 basis points. So it's up 80 basis points in a week. Even though credit spreads are low, just like the unemployment rate, it's not about them being low, it's about how quickly they moved higher. The fact that they're moving higher and how quickly they did so. And what you see is that an 80 basis point move in 1 week for this particular credit spread and index is not something that happens all that often. The last time it happened was last year during the banking crisis, and I mean right after Silicon Valley Bank, March of 2023. Before that, you got to go back to July 2022, all the fireworks in the middle of 2022. February and May of 2020. December of 2018, the landmine. December 15th, or December of 2015 and February 2016 at the tail end of Eurodollar number 3. As I was just speaking, with the trouble in updating individual credits, the liquidity problems and leverage loans and junk credit in that cycle. Before that, you got to go back to August 2011, Eurodollar number 2, banking crisis, and October 2011, banking crisis. Also, May 2010, flash crash on Wall Street, Greek bonds, repo, all of that stuff. Then, of course, 2008 and 2009. Before the Great Not Recession, you had July 2007. Credit spreads rose precipitously, suggesting this thing, repricing risk, was just getting underway back then. And even September of 2001 for obvious reasons. So a big short-run move in credit spreads, regardless of their level, suggests a substantial setback, substantial liquidations. That's what we really need to focus on over the last week, is just how violent the repricing in this part of the marketplace had been, and then how much it triggered a global backlash all throughout the world, because Japan and Japanese banks are a critical element in the Eurodollar funding system. But when you combine that with bull steepening on the treasury curve, interest rate swap spreads that we've been talking about for however long now, and other markets, this doesn't seem like it's just the beginning. This weekend was not a one-off. And as the monetary system starts to break down, Japanese firms continue to become more risk averse and be negatively impacted by the shifting perceptions as well as shifting conditions in the marketplace, especially liquidity characteristics. As Japanese firms become more risk averse, as financial firms all around the world become more risk averse, we end up with financial volatility. And we get to that point where it becomes self-reinforcing. So is this just a one-off? Not likely. That doesn't mean this week is going to be a complete and utter mess. We can't tell in the short run. Nobody has a crystal ball. And the short run is completely unpredictable as it is. But over the intermediate term, first of all, we've seen this coming all along. Bull steepening on the treasury curve, sinking swap spreads, even SOFR futures, the curve there. They have all said, before we even got to the payroll report or all the labor data last week, that the economy was in rough shape, financial markets were vulnerable, and we're moving in the wrong direction over the more than short run here. So while it was focused on Japan and Japanese participation in the system, it's not really about Japan, nor is it really about the U.S. recession. It's what that U.S. recession actually represents in the bigger picture terms. While a contraction itself is bad enough, a recession, what it represents really is that we're not going to escape the last couple years scot-free. We're not going to get off without paying the price for the pandemic lockdowns and everything else. On the contrary, that's what the soft landing really was. That we could escape without having any real economic damage, long-run economic damage. A recession brings that long-run economic damage, the potential for it, back into the fold. And so we have to reprice not just short-run or intermediate-run U.S. recession risks, we've got to reprice potentially long-run risks as well, which is what the swap market has been doing since last summer. And what the Treasury market did starting last October, interrupted for that pause in between. So the markets have been moving in this direction all along, and now the data is catching up. It's likely to be bumpy from here on because repricing systemic risk is not a straightforward and painless process. I told you about 6 weeks ago that Japan was blowing a bubble in CLOs and corporate junk credit. That's the video I've got linked below, and it's useful context given everything that just happened. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.